December 2025. The Federal Reserve shocks Wall Street, cutting rates and quietly restarting $40 billion in monthly bond purchases, even as inflation holds stubbornly above target. Critics call it the stealth pivot, and they warn that Powell's grip on policy is slipping. Why would the world's most powerful central bank risk fueling inflation when growth is already stalling? The answer reveals just how many cracks now threaten the entire U.S. financial system. The Federal Reserve's December decision landed with numbers that left no room for ambiguity. The Federal Open Market Committee lowered the federal funds rate by 1/4 percentage point, placing the new target range at 3.5 to 3.75%. At the same time, the Fed announced it would begin purchasing roughly $40 billion in Treasury securities each month. These purchases, directed at the front end of the yield curve, primarily Treasury bills and notes with up to 3 years remaining, would start immediately, with the first schedule published on December 11, and operations set to begin the following day. The official language from the FOMC described these as actions to maintain an ample supply of reserves, not as an effort to stimulate the broader economy. The implementation note clarified operational details. The interest on reserve balances was set at 3.65%, the overnight reverse repurchase rate at 3.5%, and the standing repo facility at 3.75%. The New York Fed's operating statement laid out the mechanics, monthly purchase amounts to be announced on a rolling basis, with the initial pace of $40 billion a month expected to be elevated for several months before tapering. All principal from maturing agency mortgage-backed securities would be reinvested into Treasury bills. The stated intent was technical, aimed at keeping money market rates within the target range and ensuring the system's plumbing remained smooth, rather than shifting the stance of monetary policy. As Chair Powell explained in the post-meeting press conference, "We judged it appropriate to lower our policy rate by 1/4 percentage point and to ensure that reserves remain ample. These actions are designed to keep our monetary policy effective as we monitor both inflation and employment risks." Trading desks scrambled the moment the Fed's announcement hit the wires. Within minutes, the phrase stealth pivot began circulating in analyst notes and financial headlines. Market strategists zeroed in on the return of balance sheet expansion, arguing that the distinction between reserve management and outright stimulus was more about semantics than substance. One sell-side strategist described the move as quantitative easing in all but name, pointing to the pre-announced monthly purchase schedule and the open-ended commitment to keep reserves ample. Commentary from large investment banks suggested that the Fed's technical language failed to convince. The sense on Wall Street was that the central bank, after 3 years of shrinking its holdings, had been forced to reverse course under pressure from fragile money markets and relentless Treasury supply. Some traders interpreted the decision as a signal that deeper structural problems were lurking beneath the surface, with the Fed acting as a backstop to prevent funding rates from spiraling out of control. Skepticism grew as strategists questioned whether the Fed's narrative of plumbing could hold. The fact that the central bank was expanding its footprint in the Treasury market while inflation remained above target fed doubts about its ability to maintain discipline. One prominent market economist summed up the mood. If the Fed is buying bills to keep the system running, that is not just technical support. That is an admission that the market cannot stand on its own. The stealth pivot label stuck, as investors began to wonder how much control the Fed really had over the forces it claimed to manage. Tariffs introduced in early 2025 began to ripple through the economy, altering the price tags on everything from imported electronics to household furniture. Scanner data tracking more than 350,000 goods reveal that imported durable goods, especially vehicles, electronics, and furniture, saw the sharpest increases. By August, prices for these items had climbed roughly 5% above their pre-tariff levels, a reversal from prior years when many categories were seeing outright price declines. The impact was not limited to imports. Domestic manufacturers faced rising costs as tariffed components and materials fed into their supply chains. Producer prices for U.S. made goods with high import content rose between 2.5% and 3.8% above trend, with the effect showing up gradually at the retail level. Retailers did not pass these costs through overnight. Many absorbed the initial shock by trimming margins or running down inventories. only about a third of the predicted price increases appeared on shelves by late summer, as stores delayed adjustments in hopes that the tariff regime might prove temporary. For consumers, the sticker shock arrived in waves. Durable goods categories such as motor vehicle parts, appliances, and electronics led the way, while sectors less exposed to global supply chains like books or fuels saw little change. The pass-through was uneven and slow, but persistent. By late 2025, the durable goods price index had diverged sharply from the broader inflation trend, standing out as a clear outlier in the monthly reports. The result was a one-time upward shift in the price level, concentrated in goods most reliant on foreign inputs. Tariffs acted as a tax, raising costs across entire product lines, and the effects filtered through to headline inflation figures. The adjustment was still underway as the year closed, with economists warning that the full impact could take up to a year to materialize. For the Federal Reserve, this created a dilemma. The last mile to 2% inflation was being blocked not by demand, but by a policy-driven supply shock. Academic economists have long warned that a central bank's credibility rests not just on words, but on the public's belief that it will do whatever is needed to keep inflation anchored at its stated target. For decades, the Federal Reserve's 2% goal has served as a kind of North Star, guiding wage negotiations, business contracts, and even the structure of long-term debt. But as inflation lingers around 3%, a new risk is taking shape: the possibility that markets and households will quietly re-anchor their expectations to this higher level. Recent surveys show that while short-term inflation expectations remain volatile, longer-term forecasts have edged up. In the University of Michigan's December reading, 5-year inflation expectations ticked to 3.1%, their highest since the early 2010s. Market-based measures, like the 5-year forward rate, have also drifted above pre-pandemic norms. Monetary theorists such as Michael Woodford and Ricardo Reis have published research showing that even a small, persistent overshoot can bleed into wage setting and price contracts, making it much harder to bring inflation back down without a severe economic slowdown. That research highlights how persistent expectations can become self-reinforcing. The dilemma for the Fed is clear. By tolerating inflation above target while simultaneously easing policy and expanding its balance sheet, the institution risks sending an unspoken signal that 3% is in practice the new normal. This is not just a technicality. If the public starts to believe the Fed will accommodate higher inflation, the entire framework of forward guidance begins to unravel. The cost is not just reputational. Future rate hikes may need to be sharper and more painful to regain lost credibility. For central bankers, the threat is existential. Once expectations slip their anchor, the tools to restore them become blunt and costly. Treasury borrowing in 2025 has reached a scale that strains the financial system's core. With annual net interest costs projected to approach $1 trillion, the government's funding calendar has become relentless. Every week brings a new wave of bill and note auctions, flooding primary dealers and money market funds with fresh supply. Repo spreads have widened, and the standing repo facility has seen elevated usage, subtle signs of stress that money market analysts watch closely. The Federal Reserve's official language points to the need for ample reserves and technical management, but the sheer volume of government debt is crowding out private liquidity. Without the Fed's intervention, dealers would be forced to absorb more supply than their balance sheets can handle, risking a spike in overnight rates. The mechanics are clinical, but the stakes are real. A breakdown in funding markets could ripple through the entire economy, tightening credit and slowing growth at the worst possible moment. President Trump's promise to announce a Federal Reserve successor in January 2026 has cast a long shadow over Jerome Powell's final months in office. With Powell's term set to expire in May, speculation over the next chair has moved from the sidelines to the center of financial coverage. Names circulate in analyst notes, and prediction markets are already reflecting odds on potential replacements, though no official shortlist has surfaced. The effect is unmistakable. Investors and policymakers now weigh every Federal Reserve move against the possibility that a new, more hawkish leader could soon rewrite the playbook. This uncertainty erodes the power of Powell's forward guidance. Policy announcements lose their anchor as markets look past the current chair, pricing in what the next administration might demand from the Federal Reserve. For Powell, the authority that once came from clear communication is now diluted, replaced by a sense that control over the future path of monetary policy is slipping away. As the Federal Reserve prints billions just to keep markets calm, confidence in monetary policy grows fragile. When emergency measures become the norm, the boundaries of central bank power blur. What happens next isn't just economic, it's political. The real test of trust starts now. Share your thoughts below.